So for the past few years, you've seen inventory levels contracting. And in June, again, they're down over 7% year on year. But what's really interesting is if you look at the month-on-month numbers. So you do see some seasonality as you go through the spring market. You'll see month-on-month increases starting in January. But the difference between May and June was over 4%. This time last year, less than 1%. So inventories are up versus June. Prices are up versus June. Market times are up versus June. This is really unusual. Normally when you see inventory coming up or market times growing, you'll see prices flat or down. But prices are actually increasing.
I don't believe that appreciation will continue. Our forecast for the next year through May of next year will be about 6% house price appreciation, which is half of where we are today. And the main reason for that is the pent-up supply, people who don't have enough equity in their homes, who are not participating in the market right now and creating tight inventories and driving prices up. That price increase is exactly what will allow them to enter the market. So it's sort of a virtuous cycle of price appreciation relieves the pressure for further appreciation. So we believe the whole thing will slow down. And that's not actually necessarily a bad thing. I don't think we would want price appreciation to go 12% a year indefinitely. We've done that once before and we saw the outcome of that.
Prices are now rising as fast as they were during the bubble years, but prices are still low relative to the levels where they were back then. So prices are not overvalued. In other words, we're not in a bubble right now. In fact, prices look like they're lower than normal levels rather than higher than normal levels. It means prices would have to rise a lot more before we got back into bubble territory.
No, we're not in a bubble yet.
Okay.
I mean, yet, if it continued like this, of course it would.
Prices would have to rise at double-digit rates for several years before we got back into bubble territory. And they won't. There are three big reasons why prices won't keep rising as fast as they have been. First of all, higher mortgage rates make housing more expensive. That means people can't afford as much house, and they can't pay as much for a house. The second is we're actually starting to see more inventory come onto the market. Inventory's been so tight. Earlier this year, inventory was at a 12-year low. But now, rising prices mean that more people are thinking about selling their homes, and more builders are starting new construction, which is bringing more inventory onto the market. The third reason is we're seeing less investor interest than we had. Because prices aren't as low as they were a year ago, there aren't as many bargains for investors.
The one big, I think, pool of risk for the market right now is the underwater homeowners still. There's 11.3 million of those nationwide. That it's not going to just take 1 year of appreciating home prices for them to get out of that position. It's going to take 2 or 3 years before they actually have equity in their homes. And until we have those people in a place where they can actually participate in the market, there's still a little bit of a drag on the housing market.
Mortgage rates have the ability to perhaps attenuate the market a little bit, but I don't think it's enough to really stop this train that has left the station.